The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances.
My name is Jakob Brost, and I'm an associate advisor at John Gelman Associates. Today we're here to talk about sunsets, but not the ones you think of when you think of a romantic walk, but the sunset of tax laws and legislation. Before we get into what makes up the article, we're going to first give a little background of what this article is about. This article is about the Tax Cut and Jobs Act that was enacted in 2017. This made a lot of changes to the tax system, some of which you may have heard or know about from doing your taxes the past couple of years. But as it stands currently, this act is set to sunset in 2026 and will bring back a lot of the changes that were in our tax law before the act was enacted. So now let's get into the article and some of the changes you'll be seeing in 2026 if nothing changes from now until then. One of the biggest changes happening with this Tax Cut and Jobs Act is the estate and gift tax lifetime exemption. One major component it almost doubled the gift taxes exemption from about 6 million to where it stands currently in 2024 at 13.61 million. This is per person, so as a couple, you could easily have an exemption up to 27 million. As it stands currently with the sunset, this limit will be decreased to about 6.4 million per person in 2026. Now, this is a huge change and can bring up some serious implications into your estate plan. It's not often you come across people with net worths of over 27 million, but much more reasonable with a 12 or 13 million cap for a couple. This is going to bring in a lot of changes to your estate plan and something you'll definitely need to consider if nothing changes before then. Another big change that will come with the sunset are your marginal tax rates or tax brackets. The TCJA lowered the tax brackets pretty significantly. So currently with the TCJA, the rates are 10%, 12%, 22, 24, 32, 35, and the highest bracket being 37%. So before the Tax Cut and Jobs Act and as it stands currently when it sunsets, the limits will be raised to 10%, 15%, 25%, 28%, 33, 35, and the highest bracket being 39.6%. So as you can see, if you compare those two numbers, there is some significant increase in the tax brackets there. Another difference that came about when the Tax Cut and Jobs Act was brought into play was your standard and itemized deduction. So we'll talk a lot about those two in the next couple of minutes here. So the Tax Cut and Jobs Act significantly increased the standard deduction. Before the Tax Cut and Jobs Act and made this change to the standard deduction, 47 million tax returns itemized for their taxes. After the changes were made, only 18 million still itemized. Now that's a big change. I mean, you're cutting it in over half, and it really simplified the process, as we'll get into more later in our discussion, but it made the tax planning process and preparation process a bit easier for everyone. In 2024, as it stands currently, these are the standard deductions: 29,200 for married filing joint, 21,900 for head of household or surviving spouse, and 14,600 for single or married filing separate. One of the biggest changes that resulted in that 47 million itemized down to only 18 was the SALT limit. SALT stands for state and local taxes, and this limit was set at $10,000. So what makes up that SALT is your income tax or your sales tax, and then your property taxes as well. Depending on your situation, if you're a higher net income individual, you can see your income taxes can make up a big portion of that. Also, if you have several properties or several very expensive properties in really high value neighborhoods, that is a big disadvantage to having those limited to $10,000. That was one of the big reasons why so many people went from itemizing before the Tax Cut and Jobs Act to moving to the standard deduction after. Well, that's a great scenario that will happen in 2026 if this act does in fact expire. There will also be phase outs for the itemized deduction depending on your AGI over certain thresholds. The current standard is 3% of the amount you exceed over the AGI threshold, and this will also be capped at 80%. Another aspect of the itemized deductions that will be changing with the sunset is the mortgage interest you're able to claim on your tax return. During the current Tax Cut and Job Act, so as it stands currently, you're only able to claim mortgage interest on home equity debt up to $750,000. In 2026, you'll be able to claim this on up to $1 million of mortgage debt. Another advantage to the sunset can be that you'll be able to deduct interest on home equity loans up to $100,000, and this is regardless of the purpose, so it doesn't have to be for any specific reason that you take out that home loan. Another portion of the itemized deductions that will be coming back with the sunset are miscellaneous itemized deductions. You may have heard of these before, but these consist of unreimbursed employee expenses, tax preparation fees, and even investment management fees and expenses. So these will all be brought back, but they will only be brought back at the over 2% of your AGI level. So now that we've got all that out of the way between the standard and itemized, this is going to bring back a lot of tax planning, specifically on the itemized tax side of things with that. So next up, another big change that was brought on by the Tax Cut and Job Act has to do with pass-through businesses. While it did permanently lower the corporate tax rate to 21%, it did not make any permanent changes to pass-through businesses. So what a pass-through business is the income from the business flows through the individual on their personal tax return. As you can see from the tax brackets we discussed earlier, this can be a big disadvantage as opposed to a corporation only paying 21% on that income. So what the Tax Cut and Jobs Act did, it created a deduction, which was subject to limitations and thresholds, but a deduction for pass-through businesses to help kind of even the playing field in a sort. This deduction is set to expire with the sunset in 2026. So this can be a big issue, and I'm sure on a lot of business owners' minds in the next couple of months and years. Another change that's going to be coming has to do with child tax credits and credits for other dependents. There will be max credits and thresholds. Those currently will be reduced in 2026. Also, the credit for other dependents will be completely removed. And this other dependents just basically is for dependents that might not meet the child tax credit criteria. Another change has to do with personal exemptions. You might have heard of these a long time ago, but these were around in 2017 before the Tax Cut and Jobs Act. Basically, you get a exemption for your taxpayer, their spouse, and any dependents they might have. It was $4,050, but this also was phased out depending on your AGI. When this sunsets, these will be brought back. These were currently not allowed during the last couple of years, and they were set at $0. It will still likely be phased out for AGI threshold. So if you're at higher income and higher brackets, you may not see any effect on that change. Another change has to do with charitable cash contributions. So these are only have to do with cash contributions to public charities. There's several other limits and thresholds for other types of charitable contributions, but for the cash and to public charities, the TCJA increased the limit to 60%. As it stands currently with the sunset, this will be decreased back down to 50%. One last change that we can discuss from the article has to do with AMT, or alternative minimum tax. This tax, a lot of people don't have to worry about, but its idea is to kind of level the playing field for extremely high income individuals who can take advantage of tax deductions and credits and greatly lower their tax burden. It just helps make sure everyone's paying their fair share in taxes, but the change is the phase out thresholds will be lowered with the sunset. So in a short, quick summary of what the changes will be if this sunsets. And just as a note, we cannot be sure if it will sunset or if there will be legislation that extends it. As it stands currently, it is still set to sunset in 2026. So with that being the case, a short summary is your tax rates might go up. The estate and gift tax exemptions will go down dramatically, almost cut in half. Standard deductions will go down, but potentially your itemized deductions could go back up, so it could even out there. Exemptions will be brought back, personal exemptions, and other dependent or child credits will be reduced or even removed. Lastly, the pass-through business owners will lose their deduction and likely will end up paying more in taxes. So what to do before 2026 comes and these changes are brought into play. Again, just one more reminder, we can't be sure what's going to happen, but as it stands currently, it is set to sunset. So a lot of tax planning will be a big focus around this act and this sunset. One thing we recommend is try to plan your income. This is a lot harder for W-2 employees or people still in the workforce, but mainly for retirees. Maybe you see yourself going on a big vacation around 2025 or 2026, or maybe buying a new car. Whatever the case may be, maybe taking out a big distribution from your IRA. With it set to sunset, it may be better to take it out earlier rather than later and getting hit with those higher tax brackets. Roth conversions are something that have become pretty popular lately. This is the idea of kind of converting some of your pre-tax money into after-tax dollars, but with that being said, you still have to pay taxes on that when you make that conversion. So maybe accelerating those over the next couple of years to take advantage of lower tax brackets. You can harvest some capital gains. And another big thing would be timing some of your deductions. So if you have any charitable intentions coming up in the next few years, it may be better to take advantage of those after the tax brackets go up to save yourself some more money in taxes. Another big aspect to focus on is estate planning. Like I said, that exemption being cut in half brings a lot more issues for that 12 to 25 million in net worth crowd. So there's something you're definitely going to need to talk with your attorney or financial advisor about to get some advice. There are a lot of strategies you can use to help avoid this, but something you should definitely consider as the sunset comes up in 2026. Other ideas are 529 plans. You can do accelerated gifts, so one big gift in 1 year that equates to about 5 gifts over 5 years. That could help lower your estate and maybe even be under that thresholds. Utilize trusts, kind of like I said, there's tons and tons of different style trusts for different situations that could help you avoid some of that estate tax and potentially even transferring assets to family members earlier than what you might have expected just to avoid that estate tax. One last thing I'll mention is on the business planning side of things, this could be a time for pass-through business owners to reevaluate their business structure and maybe make some changes. Again, we can't be sure if it will sunset or if it will be extended, but as it stands currently, this will removing that pass-through income deduction for those business owners will result in a lot of extra taxes paid compared to what they're used to. Other than that, those are the main changes and what to expect, as long as nothing changes and this Tax Cut and Jobs Act still does sunset in 2026. Thanks for watching and hearing more about the sunset of the Tax Cut and Jobs Acts in 2026. If you enjoyed this video, please subscribe to our channel and click the YouTube logo in the bottom right corner. And feel free to reach out if you have any more questions on this topic.